For millions of people, the weekend once began under blue and yellow lights. You walked through a glass door and faced a wall of new releases. Empty display boxes created the illusion that every movie was waiting for you, even when every copy was already gone. Families negotiated. Teenagers wandered. Someone held up a box and asked the most important question of the evening. How about this one? Blockbuster did not merely rent movies. It turned choosing a movie into a public ritual. At its peak, the company operated more than 9,000 stores around the world and generated more than $6 billion in annual revenue. It was one of the most recognizable retail brands on earth. Then the stores began disappearing. The easy explanation is that Netflix arrived, Blockbuster laughed, and the future punished it. That story contains a famous meeting and a satisfying villain. It is also incomplete. Blockbuster saw digital delivery coming. It built an online rental business, offered subscription plans, experimented with kiosks, and formed partnerships for digital devices. The real question is harder. Why could a company with enormous scale, a powerful brand, millions of customers, and thousands of convenient locations not transform quickly enough to survive? To answer that, we have to understand why Blockbuster became so powerful in the first place. Because the machinery that created its rise also shaped its fall. In 1985, most American video stores were small independent businesses. Their selection was limited, their shelves could feel chaotic, and their inventory decisions often depended on instinct. David Cook approached the problem differently. Cook had worked in computer software for the oil and gas industry. When he opened the first Blockbuster in Dallas on October 19, 1985, he treated movies as data. The store reportedly carried roughly 8,000 tapes, an unusually large selection, and used a computerized checkout system to track what customers rented. That mattered because videotapes were expensive. A store could not simply buy unlimited copies of everything. It needed to know which genres moved, which titles sat idle, and how many copies of a hit could earn back their cost before demand disappeared. Blockbuster also changed the atmosphere. The stores were bright, clean, standardized, and designed to feel safe for families. Titles faced outward like products in a supermarket. The blue and yellow ticket-shaped sign was visible from the road. Customers did not need to know a local owner or navigate an eccentric collection. They knew what a Blockbuster would feel like before entering. The first store succeeded. More followed. But the decisive acceleration came after a group led by Wayne Huizinga invested in the company in 1987. Huizinga understood how to roll up a fragmented industry. Buy local chains, convert them to one brand, standardize operations, and keep expanding. Blockbuster was no longer just a clever video store. It was becoming a system. Scale solved several problems at once. A national chain could negotiate with movie studios, advertise across entire markets, spread technology costs across thousands of locations, and move inventory more intelligently than a single neighborhood shop. It could acquire competitors and convert their customers overnight. The company also benefited from revenue-sharing arrangements. Instead of paying the full wholesale cost for every copy up front, a retailer could obtain more copies of popular titles and share rental revenue with the studio. More copies meant fewer disappointed customers during the crucial opening weeks. The store captured demand while the movie was culturally relevant, then sold used copies later. The economics looked beautiful when traffic was growing. A store already paying rent and staff could earn high-margin revenue from one physical tape again and again. A copy rented 10, 20, or 30 times. Candy and merchandise added more sales. Late fees extended the value of inventory by charging customers who kept it longer than promised. Every new location made the network more convenient. Every familiar sign reduced the risk of choosing the store. Every customer account produced more transaction data. By the early 1990s, Blockbuster had turned an informal local business into a repeatable retail formula. In 1994, Viacom announced an acquisition valued at $8.4 billion. The deal connected the rental giant to a larger media empire and helped Viacom pursue Paramount. Blockbuster had gone from one Dallas store to strategic currency in Hollywood in less than a decade. But scale has a hidden cost. The larger the machine becomes, the more expensive it is to change what the machine does. By the end of 2004, Blockbuster reported 9,094 stores worldwide, 7,265 company-operated locations, and 1,829 franchised or joint venture stores. Annual revenue reached approximately $6.05 billion. This was the empire at full size. Yet the company's own annual report already described a decline in the active member base and growing competition from other forms of home entertainment. The store network was simultaneously Blockbuster's greatest advantage and its largest obligation. Each location needed rent, utilities, employees, inventory, maintenance, point-of-sale systems, and advertising. Those expenses did not fall automatically when one customer decided to order a disc online or buy a DVD at Walmart. At the same time, DVDs were changing consumer behavior. They were cheaper to manufacture and easier to mail than VHS tapes. Retail prices fell, making ownership more attractive. Cable companies expanded pay-per-view and video on demand. Mass merchants sold new releases near the grocery aisle. A movie night no longer required a dedicated trip to a rental store. Blockbuster was not yet collapsing. $6 billion in revenue is not the profile of an irrelevant company. But the direction of the market had shifted. The physical store could still produce cash, while the next generation of distribution demanded investment. That created a dangerous temptation. Protect the profitable old model long enough to finance the new one. In theory, this is sensible. In practice, the old model often declines faster than the new business becomes strong enough to replace it. Netflix began as a DVD by-mail company in the late 1990s. It removed the trip to the store and, through subscriptions, removed the anxiety of traditional late fees. Customers built an online queue. Red envelopes arrived through the mail. Returning one disc triggered the next. According to Netflix co-founders Mark Randolph and Reed Hastings, they met Blockbuster executives in 2000 and proposed that Blockbuster buy Netflix for about $50 million. Blockbuster declined. It is an irresistible story when told from the future. But in 2000, Netflix was an unprofitable startup built around mailed DVDs. Streaming video was not yet the product people imagine today. Broadband access was limited, and Blockbuster had thousands of stores generating billions in revenue. Rejecting Netflix may have been a missed opportunity. It was not, by itself, the cause of Blockbuster's bankruptcy 10 years later. Acquiring a different business does not guarantee that a large company will protect it, fund it, or allow it to disrupt the core operation. The deeper mistake was not failing to predict one company's future valuation. It was underestimating how quickly convenience would be redefined. From a store near your house, to a disc in your mailbox, to a movie available instantly on a screen. Late fees were hated by customers and valuable to Blockbuster. In December 2004, the company announced the end of late fees at thousands of participating U.S. stores beginning in 2005. The promise was designed to remove the most common complaint about renting from a store and answer subscription competitors. The financial trade-off was enormous. Blockbuster estimated that extended viewing fees would otherwise have contributed roughly $400 to $450 million of revenue in 2005 and approximately $250 to $300 million of operating income. The company hoped greater traffic, lower marketing needs, and other savings would offset part of the loss. But the program was complicated. Customers could keep a title beyond its due date without a traditional daily fee. Yet after a grace period, the rental could be converted into a sale, with restocking rules if it was later returned. Some attorneys general challenged the advertising, and the message that sounded simple in a commercial was less simple at the counter. More importantly, removing a disliked fee did not remove the cost structure beneath it. The stores still needed rent and labor. Inventory still had to be purchased. The company had surrendered a large profit stream while investing in its online challenge. This was the innovator's dilemma in retail form. Customers wanted the feature removed precisely because the company had become economically dependent on it. Blockbuster did not sit still. It launched Blockbuster Online in 2004. It offered subscription passes. In late 2006, it introduced Total Access, allowing online subscribers to return mailed DVDs at a store and exchange them for an in-store rental. This combined the convenience of mail with the immediacy of thousands of locations. For a moment, the store network looked like an advantage again. Blockbuster expected to reach 3 million Total Access subscribers by the end of the first quarter of 2007. Customers could move between online and physical channels in a way Netflix could not match. But the growth was expensive. Aggressive pricing, advertising, postage, disc purchases, and free in-store exchanges created large operating losses. In the second half of 2007, Blockbuster shifted toward profitable growth. It reduced marketing and raised prices. Subscriber momentum weakened. By the end of fiscal 2007, Blockbuster reported 2.8 million by-mail subscribers. 2 years later, that figure was about 1.4 million. This is one of the most important moments in the story. Blockbuster did build a credible response, but it needed time and capital to absorb losses while the new model scaled. The company was trying to win a long digital transition while still supporting a massive physical estate and servicing debt. Innovation was not absent. Financial room was. Netflix was only one competitor. Redbox kiosks put low-cost rentals outside supermarkets and convenience stores. They offered fewer titles, but they were cheap and positioned along trips customers were already making. Cable video on demand removed the return entirely. Apple and Amazon expanded digital purchases and rentals. Piracy provided an illegal substitute. DVD prices kept making ownership attractive. Then streaming changed the unit of convenience again. Netflix began streaming in 2007. The advantage was no longer merely avoiding a store. It was avoiding physical media, postage, inventory shortages, due dates, and returns. Blockbuster experimented across these channels. Its 2009 annual report described digital partnerships, an iPhone application, and more than 2,000 branded kiosks operated through an agreement with NCR. The company understood that distribution was fragmenting, but each response competed for limited cash and management attention. A store chain, a buy-mail subscription, a kiosk network, and a digital platform are not one business with four doors. They have different economics, technologies, partners, and customer expectations. Meanwhile, every underperforming store had a lease. Closing locations cost money. Keeping them open cost money. Shrinking the old machine consumed resources needed to build the new one. Technology explains why Blockbuster's market changed. Debt explains why its options narrowed. When Blockbuster separated from Viacom in 2004, it paid a special distribution of approximately $905.6 million to shareholders, including Viacom. By the end of that year, Blockbuster reported roughly $1.04 billion in long-term debt, excluding the current portion. Debt is not automatically fatal. In a stable business, it can amplify returns. In a shrinking business, it turns time into an enemy. Interest and principal must be paid even when revenue falls. Lenders impose covenants. Suppliers may demand tighter terms. Management becomes less able to fund experiments whose payoff is uncertain. Blockbuster's 2009 annual report warned that debt service reduced cash available for working capital, inventory, capital expenditures, acquisitions, and general operations. It also warned that the company might need to reduce or delay investment, restructure obligations, or seek bankruptcy protection. This is why the story cannot be reduced to managers refusing to see the internet. Blockbuster was attempting to change while cash from the core business was declining and financial obligations remained fixed. Every dollar spent subsidizing total access was a dollar unavailable for debt. Every price increase that improved short-term economics made the online product less competitive. The company did not only have to choose the correct future, it had to survive the cost of reaching it. The decline accelerated. Worldwide revenue fell from approximately $5.31 billion in fiscal 2007 to $4.06 billion in fiscal 2009. The store count fell from 9,094 at the end of 2004 to 6,520 at the end of 2009. U.S. revenue alone dropped more than 20% in fiscal 2009, and worldwide same-store revenue declined 13.1%. The stock market had already delivered its verdict. A $100 investment benchmarked at the end of 2004 was shown in Blockbuster's 2009 annual report as worth only $6.73 by early 2010, before dividends. Falling sales damaged more than profit. Studios worried about getting paid. Credit ratings deteriorated. Refinancing became harder. Closing stores reduced reach, which weakened one of the features that made total access attractive. The network effect began operating in reverse. On September 23, 2010, Blockbuster and several U.S. subsidiaries filed for Chapter 11 bankruptcy protection. Contemporary filings listed about $1.02 billion in assets and roughly $1.46 billion in debt. The blue and yellow signs did not all disappear that morning. Bankruptcy is a legal process, not a light switch. Stores continued operating while the company sought a buyer and restructured. But the corporate race was over. A business once valued at billions no longer controlled its own future. In April 2011, Dish Network won the bankruptcy auction for substantially all of Blockbuster's assets. The bid was valued at approximately $320 million, with expected cash paid at closing of about $228 million after adjustments. Dish described a famous brand, more than 1,700 store locations, and multiple delivery methods that could complement its television business. Yet the remaining stores continued to close. The final company-owned U.S. locations shut in January 2014. Franchises lasted longer. Their economics were local. Their owners could operate differently, and some served places where physical rentals retained unusual value. But one by one, they also disappeared. By the end of March 2019, only one Blockbuster remained anywhere in the world. A franchise store in Bend, Oregon. The chain had completed an extraordinary compression, from more than 9,000 locations to one. The Bend store survives because it is no longer merely a node in a global rental network. It is a local business, a tourist destination, a merchandise brand, and a living museum. Visitors photograph the sign. They browse physical shelves. They buy souvenirs that help support the operation. Longtime customers still rent movies. The store offers something streaming cannot deliver: a place, a memory, and the social experience of choosing. That does not mean the old Blockbuster model was secretly viable. The final store survives by being exceptional. The scarcity is part of its value. So what actually killed Blockbuster? Not one meeting, not one competitor, not one executive fee or technology. Blockbuster was built to dominate a world in which movies were scarce physical objects and convenience meant having a large store nearby. It optimized that world brilliantly. Then DVDs became cheaper, mail subscriptions removed the trip, kiosks undercut the price, on-demand removed the return, and streaming removed the object itself. The company responded, but every response had to coexist with thousands of stores and a heavy financial burden. The old business declined before the new businesses could replace its cash flow. The lesson is not simply that companies should innovate. Blockbuster did innovate. The harder lesson is that transformation requires the willingness and the financial capacity to damage the business that made you successful before somebody else does it for you. Today, the last Blockbuster remains open beneath the same familiar colors. It is a monument to a company that once owned Friday night, and a reminder that the most dangerous moment for a dominant business is when its old model still looks too valuable to abandon.